Good day, guys. It's so nice to have you here. Um, I will be going through the introduction to Forex trading for beginners. Introduction to Forex trading for beginners. In this video, you'll be learning the full details of what Forex trading is all about, and you'll be having the in-depth knowledge of how to navigate the Forex market and understanding the basic terminologies you know as a Forex trader, the beginner Forex trader. So it's nice to have you on board. Make sure to stick around and watch the end. And if you are yet to subscribe, do that. Now, what is Forex? As you guys have been hearing before coming to this video, before checking out this video, you must have heard of what Forex or FX or Forex. Like, what is the Forex trading? Like, you'll be wondering, what is Forex all about? Or what is FX all about? FX simply stands for what? Forex. And Forex simply means what? Forex is simply an acronym for what? For foreign exchange. Just like you can see in this slide, Forex, foreign exchange. Now, the FX market is the market where you can trade currency, where you can trade what? Currency. The exchange. Let me give you a simple example to simply to Forex trading for you to be able to understand what foreign exchange simply is all about. Just like you traveling from your own country to that country, on getting to the airport of the new country that you travel to, you have to exchange your, or either from your own airport, you have to exchange your currency to the new country's currency that you're actually going to. Now, the process of engaging in that transaction, you simply what? Engage on what? Forex trading. The trading of one currency, one country's currency to another, the exchange of one country's currency to another. That's simply what? Forex exchange. That's simply what Forex is all about. Now, Forex is an over-the-counter market. It is a decentralized market with no actual central exchange. With no actual central exchange. It is open 24 hours a day, 5 days a week, and it is closed on weekends. Yes, Forex market is closed on weekend. It opens on Monday to Friday. Foreign market, foreign Forex opens from Monday up to Friday. It opens very early, Sunday night, stroke Monday, and it's closed on Friday. And Forex is the world's biggest market. Yes, Forex is the world's biggest market. It's over $10 trillion traded per day. Forex is the world's biggest market. Forex is the world's biggest market. Now, who trades Forex? Trade Forex. Trade Forex. You'll be surprised to see the amount of people that trade Forex. Number one on the list, we have the government and central bank. Yes, government of every country engage in what? Forex trading. And what is their responsibility? What do they do? What do they come to do in the market, in the Forex market? And the central bank, what do they have to do? What do they come to do in the Forex market? They simply do what? Intervene in the market to strengthen or weaken their currency. Each country, government, or central bank, they are obliged with the responsibility of what? Of strengthening their country's currency or weakening the country currency. And that depends on a lot of factors, which can be either inflation or deflation. So they come into the market to either stabilize, strengthen, or weaken their country's currency. And it's bad when the country currency is too powerful, and it's also bad when it is weak. So they come in to just do what? Stabilize the market, to stabilize their country's currency. Number two on the list, you have the bank and other financial institutions. People who need foreign currency for small scale transactions deal with local banks. Just like you can easily go to your country's bank with another country's currency and exchange it for your own local country currency. Bank and other financial institutions do what? They also trade Forex. They also engage in foreign exchange. They also engage in foreign exchange. The third on the list, we have the corporation repatriating profit. We have the corporation repatriating profit. What does this simply mean? Just like a company, just like a company in US can decide to open a brand. Just like okay, let me use this for example. Just like a Japanese company can decide to open its brand in US, in the United States. Now, the process of it opening its brand in United States profits that they generate, they will be making their money in dollars. The profit that they generate in dollars, process of them changing that profit, changing that dollar back to their Japanese yen. The currency they use in Japan is yen. Process of them changing their profit, which their other brand in US made, which is the dollar. The price of them changing it back to Japanese yen. They've done what? They've also traded forex. So that is simply what? Operations repatriating profits. Just like you can see here, a Japanese country that operates in US as well has to change its dollar profits back to Japanese currency when repatriating. That's very simple and straightforward. Number 4 on the list, we have the investors buying assets in foreign countries. Investors buying assets in foreign countries. An European investor can decide to what? To buy a share of Australian company. And for him to buy that share of the Australian company, for him to buy a share in an Australian company, he has to do what? He has to change his country's currency to an Australian currency before he can buy the share in that Australian country. I don't know if that's actually understandable enough for you. Just an investor. If an investor wants to buy a share, let's say an investor in any African country wants to buy a share in US or Canada or whatever, you need to, let's say Canada, for example, let's say an individual wants to, an European investor wants to buy a share in Canada, he has to first change his euro. He has to change his country currency to do what? What? Canadian dollar before he can be able to buy any share in Canada. I hope that is straightforward enough for you. Number 5 on the list, we have the speculator. Speculation is the process of engaging in what? Risky financial transactions in an attempt to profit for what? From what? Short-term fluctuations in the market value of a tradable financial instrument. Speculators can be forex traders. A lot of people coming into the forex market to do what? To engage in risky financial transactions. To produce that what? The country's currency will be low. Then use your country's currency to buy that currency. Store for a while. Sell it off when you see that the value is high. Do you understand what I'm saying now? Now, the number 6 on the list, we have the tourists. Tourists visiting other countries. Yes, the tourists also do what? They also trade forex. They also trade what? They also trade forex. The tourists also trade forex. They also trade forex. If you want to go on vacation, just like it's summer, you have to travel to another country, you have to do what? Change your home currency to the new country currency that you are going to. The new country currency. For you to be able to do what? To spend, for you to be able to purchase goods and service or do whatever you want to do in that new country. Now let's go straight to what? Currency. We've been saying currency a lot. Now what does this currency simply mean? The currency of the US is the US dollar. Yes, just like the currency Nigeria's currency is what? Naira. The US currency is what? US dollar. Canada currency is what? Canadian dollar. Just like that. Just like that. In Eurozone, we have the euro, which is shared among 19 of the 28 EU member states. Now, the UK has the pound. Yes, in the United Kingdom, the pound. Japan. In Japan, they spend what? What currency do they spend in Japan? We're all familiar with that. The yen. The yen. Now, the International Organization for Standardization, the ISO, has determined standard abbreviation for currency. That is the standard abbreviation for currency. Now, how do they come up with this short currency? Just like you see the USD, EUR, NGN, Nigerian Naira. How do they come up with this word? The 2 first letters stand for the country, and the last letter stand for what? The currency. The USD, the abbreviation USD. US is what? United States, and the D right there is what? Dollar. NGN, Nigerian dollar. NG, Nigeria. N, Naira, Nigerian Naira. I hope that's straightforward. JPY, JP is what? Japan. Japan. Y is what? Japan. Japan yen. Japanese yen. I hope you understand that. Japanese yen. So that's very, very straightforward. And euro. Euro as well. Now, how are currencies traded? How do they trade currency? How are these currencies that we say, how are they traded? The idea is more or less the same of buying stock. The idea is more or less the same as buying stock. You can buy a share of a company if you think the company is doing well and its share will increase in value. Yes, that's the same way it is. You can decide to you can decide to buy US dollar just like you decide to buy the share of a company. If you think the US dollar is going to appreciate, the process of you buying that US dollar and selling it off when it is stronger and you've been able to acquire a little profit on it, that's the same way what currencies are also traded. The same way you buy the share of a company, the same way you buy the share of a company, and when you see that it is strong, you do what? You sell it off. That is the same way what? That is the same way forex. That is the same way currency also traded. That is the same way currency is also traded. Now in FX, instead of buying the share of companies, you buy share of companies with the same logic that is currency. Now instead of buying shares of companies, you do what? You buy currencies of countries. That is just the simple logic. That is the simple logic, and it is very, very understandable. That is the simple logic. Now, if you believe that the economy of a specific country is doing well, you expect what its currency to appreciate, and therefore you buy it. You buy it. If you see that okay, there's war going on in this country, and you see that what the the currency of that country will start weakening, you do what? Sell it off. So that is just the simple idea about forex trading. That is the simple ideology. Just for example, see that the economy of the country is pumping, is doing well, and it's strong. You can do what? You can decide to buy their country currency because you know what? Anything that happens within an economy strongly affects their currencies as well. It affects their currency, whether inflation, deflation, it all affects their country currency. So if you see that, just like you see that the currency of an economy, if you see that the currency of an economy is strong, it means what the economy is doing well, that country is doing well. Just like you can see right here, when you buy a currency, simultaneously what sell another currency. Now that's the ideology about forex trading. When you buy a currency, you simultaneously what sell another currency. Simultaneously sell another currency. Just for instance, you get to the airport of a new country and you want to exchange your naira for the dollar. Let's say you travel to US and you want to exchange your naira for dollar. The process of you bringing out your naira and giving it them for the dollar, you are doing what? You are selling your naira and you are buying the dollar. You are using your currency to buy another currency. So when you buy a currency, you are automatically what? Selling another currency. You are automatically selling another currency. Now, this video is only going to be covering the part one because we can't treat it all now. Simply going to be covering the part one. I'll also send the part two video. Make sure to watch and stick around. Now, let's go straight to the point. When you buy American share, you use dollar. When you buy European equity, you use euros. You need money to buy something, even stock market, even stocks. You need money to buy something. You need money, just like you use money to buy a phone, or use your money to buy a new MacBook, or use your money to buy a new gadget. That's the same way you get another currency. That's the same way you buy another currency. How do you buy money? Again, with money, of course. You can buy euro with pounds, dollar with yen, yen with Australian dollar, dollar with naira, naira with dollar, just like that, simultaneously. Simultaneously. You've probably done an FX transaction yourself. Yes, you have done an FX transaction yourself. The process of you using your hometown currency to get another country currency, you've done what? You've automatically participated in forex trading. You've been to a country that uses when you've been to a country that uses a different currency than your country, you automatically what? Participated in forex trading. Automatically. You automatically participated in forex trading. You automatically participated in forex trading. Now the next topic we are going to be attempting, we're going to be treating is what? Currency pairs. Currency pairs. Just like you can see on many charts, probably you check your Instagram, YouTube, this and that, and you see currency pairs like USD, JPY, Euro USD, JP, GBP, Euro, GBP, Euro, Great Britain Pound, Euro, NGN, USD. I've never traded down before. I've never traded down before. XAE USD, the most popular and most volatile pair. BTC USD. Those are what? Currency pairs. Now I'm going to be explaining that term. I'm going to be explaining that terminology to you. A simple term. Now, before going into that in depth, I'm going to be explaining the type of currency pairs that we have. We have three main types of currency pairs. We have the major currency pair, we have the minor currency pair, and we have the exotic currency pairs. Yes, you heard me right. We have the exotic currency pairs. Now, when we talk of the major currency pairs, the major currency pair is any currency pair at all that has what? US dollar on its side. That has US dollar on its side. And these major currency pairs, they are the most and frequently traded what? Pairs in the world. They are the most and frequently traded pair in the world. Any currency pair that is in line with the US dollar, that is traded against the US dollar, is what? A major currency pair. Is a major currency pair. But any currency pair that is not traded alongside the US dollar is a minor currency pair. And about the exotic currency pair, I'm going to be giving you a graphical representation of that for better understanding. Now, let's go into the next. Now, they constitute what? The largest share of the foreign exchange market. Now, as you can see, for example, we have the EUR USD. That is simply what the euro dollar. Euro against the dollar. That is, you are trading the euro against the dollar. The euro against dollar. And you can see the next one we have the USD JPY. The next one you have the GBP USD. The next one you have the USD CHF. The next one you have the USD CAD. Next one you have the Australian dollar, US dollar. The next one you have the New Zealand dollar and the US dollar. Now, I'm going to be tipping in another terminology for you to actually understand. Any currency that appears first is known as the what? Base currency. Is known as the base currency. And the other currency is known as the what? The quoted currency. Known as the quoted currency. Now, let's use this first one as an example. The Euro US dollar. This first currency right here, the EUR, this first currency right here, my cursor is right on, is base currency. Why? Because it's the one coming first. And as long as it's traded against the US dollar, it is what? A major currency pair. It is a major currency pair. This one as well. Now, just like this first one, EUR, is what? The euro is what? Base currency in this instance. Is the base currency. And the second one is what? Quoted currency. Now, in this example, it means you are trading the EUR, you are trading the euro against what? The US dollar. You are trading the euro against the US dollar. And this second example, we have the US dollar, Japanese yen. Just like I told you, JPY simply stands for Japanese yen. GBP stands for what? Great Britain pound. USD stands for what? US dollar. CHF stands for what? Answer that. CHF stands for what? CAD stands for what? AUD stands for what? NZD stands for what? Now, in this second example, USD JPY, which one of them is the base currency and which one is the quoted currency? I need you to answer that. Which one is the base currency and which one is the quoted currency? You are right. First one is the base currency. The US dollar is the base currency. And the second one is what? The quoted currency. Now, in this second example, which one is the quoted currency? US dollar is quoted currency, and the GBP, which is the Great Britain pound, is the base currency. Now, let's go to the next one, the cross-currency pair of minor currency. Now, the minor currency pairs can also be called what? Cross-currency pair. It simply means what? Currency pair that does not include the US dollar. Any currency pair that does not include the US dollar is what is called what? Minor currency pair. They are also known as what? Minor. And they are most actively traded. They are also most actively traded. Example, the euro, JPY, and GBP. For example, see the mixture now. Euro, GBP. Now, can you see that these currency pairs, they do not involve what? They do not include what? The US dollar. Euro, GBP. That is what? Euro against the Great Britain pound. Great Britain pound against Japanese yen. Euro against the Canadian dollar. That's very straightforward. Minor currency pair is simply what? Any currency pair that does not what? Include the US dollar. The US dollar. Now, what are exotic major exotic currency pairs. What are exotic currency pairs? Exotic currency pairs are made up of one major currency paired with the currency of an emerging economy or a small economy from a global perspective. Now we have small economies, just like all the economies are not equal. We have stronger economies against smaller ones. Now, exotic currency pair is just like you trading the currency of a strong, except now it's just like you trading what? The currency of what? A major currency pair. A major currency pair. Now, a major currency pair can be what? Euro, Great Britain pound, US dollar, against what? Emerging countries. Countries that are just coming up. Countries that are just coming up. Just like I can see, for example. And what are the examples of countries that are just coming up? We have the Hong Kong, we have the Singapore. We have the Singapore. And you can see the example of the currency pair. Euro, HUF, Euro, ZAR. Euro, ZAR. So you can see, for example, we are trading a major currency. We are trading a major and strong currency against a small country, a small economy, a small economy, a small economy. Yeah, that's very, very straightforward. Now, going into trading Forex. Trading Forex. Now, how does all of these terminologies apply to trading Forex? How do they come in line with trading Forex? How do they relate to trading Forex? What does it mean to trade Forex? Yeah. Now, trading Forex is buying a currency and at the same time selling another currency with the idea that what? The currency that I bought will go up and the currency that I'm selling will come down. That's very simple and straightforward. Trading Forex is simply what? Buying a currency. You're buying a currency and at the same time buying that currency, you're what? You're selling another currency with the idea that what? That currency that I bought will be stronger and that currency that I'm selling will come down. Now, see the example you have there. Buy Euro USD. That is, you are buying the Euro, you are buying Euro, you are buying Euro and you're selling dollar. What's the ideology behind this now? It means that what? You are predicting or you are analyzing, not just predicting, with market fundamental analysis, technical analysis, combining everything together. You can see obviously that what? The US dollar will be weakened against the euro. The US dollar will be weakened against the euro. And when you see that from your analysis, the US dollar will be weakened against the euro, you do what? Sorry, you see that what? The euro will be weakened against the US dollar. See that the US dollar will be stronger than the euro. And what are you doing in that instance? You are selling the euro. Just like you can see in this second example that I highlighted here. This second one I highlighted here. You are selling the euro and you are buying the dollar. And you can see this graphical representation right here. So when I want to exchange in Forex, the process of, let's say, NGN USD, sell, let's say I place a position, sell NGN USD. It simply means I'm saying what? I'm selling my Nigerian Naira and I'm buying the US dollar. I don't know if that's straightforward. When you say buy US dollar, buy gold, it means that what? It means that what? You are buying gold and you are selling the US dollar. It gets more clear as go on. Gets more clear. And you can see this graphical representation. This graphical representation. Buy US dollar, you are buying the euro, buy euro USD. You are buying the euro and you are selling the dollar. The first one, you are buying the first one, you can see right here, buy USD. You are doing what? Buying the euro and you are selling the dollar. And you can see sell euro USD. You are selling the euro and you are buying the dollar. It depends on this first action right here that determine whatever you are doing against each other. Now let's go into the next. Let's go into the next. Now, talking about the history and evolution of Forex trading. Before 1996, the only group that were able to trade Forex were large financial institutions like the central bank, corporations, government, hedge fund, and extremely wealthy people. Why? Because you have to bring a lot of money to be able to participate in Forex trading, but it is no longer the same. Back then, it was very difficult to take part in Forex market because you needed much larger balance than you need today in order to exploit decent profit. Fast forward to in 1996, Forex trading started becoming more practical and more accessible by individuals due to the development of internet-based trading. Yes, internet-based trading, and that's where the brokers come in. You get to understand that as you go on. Now you can trade currency in a matter of seconds. Yes, you can trade currency. I can simply stay in my room and be trading the euro without getting to Europe. I'll be trading the without I can be buying the euro without going to any European country. I'll be selling the US dollar without actually having to be in the United States. I'll be selling the Nigerian naira without actually having to be in Nigeria. I hope that is clear enough. Now, talking about retail FX trading. Talking about retail FX trading. Let's go right into. Now, this video will only cover the part one. I'll be stopping very soon. It will only cover. I'll stop right here after this retail FX trading. I will continue from here. Now, retail FX trading is a small segment of the overall foreign exchange market. Individuals do not actually buy or sell currency. You don't need to have yen in your pocket. You don't need to have yen in your pocket to buy pounds or Swiss francs to buy Russian rubles. It is speculations on the exchange rate between two currencies through contracts of differences. Now, that's what we call CFD. CFD simply stands for contracts for differences. If you expect the rate of a currency pair to go up, you enter a long position. Now, talking about long, talking about when you hear traders say, we long the US dollar and we short the euro. It simply means what? Long in Forex trading simply means what? Buy. It simply means what? Buy. And short simply means what? Sell. Short. The word short simply means what? Sell. So when you hear traders say short euro USD, it means what? Sell euro USD. It means sell euro USD, which you are selling the euro and you are buying the dollar. That's straightforward. And when you hear long gold, it means that what? You are buying gold and you are selling the US dollar. Very straightforward. If you believe that the rate will go down, you initiate a short. That's why you can see right here. If you see that the rate will go down, you initiate a short position, selling the base currency and buying the variable. That the variable in that extent, what is the quoted currency, just like I taught you, quoted currency. Now, talking about, let's go into the next topic, which is margin and leverage. Talking about this margin and leverage, I think this should fall in the part 2 of Forex trading for beginners. I think I should make this part 2 because you still have a lot to cover. Let me take this. Okay, let me take this. Let me take this and I'll stop under pips. And from pips, the part 2 will actually start from here. So talking about margin and leverage. Talking about margin and leverage, what does margin and leverage mean? And how the traders actually place position in Forex trading. Usually, when something costs 10,000 euros, you actually need to pay what? 10,000 euros for it. You need to pay 10,000 euros for it. But in Forex, you don't need to have the whole price of what you're buying. In one trade, you can commit much less than the amount you want to trade. Yes, that is the good thing about Forex trading. In one trade, you can commit much less than the amount you actually want to trade. The amount you commit is called margin. The amount that you commit is called margin. The trade size is usually a multiple of your margin, and the multiplier is called leverage. The multiplier is called leverage. Leverage gives you the opportunity to place bigger trades, to place trades above your initial capital. Because if we didn't have the privilege of leveraging in Forex trading, if you are going to place trade on euro and you are looking forward to trade about 10,000 euro, you need to actually put in 10,000. You need 10,000 euro digitally. to be able to actually what operate in that transaction. But in Forex, you don't need that. With the help of leverage, you don't need to have up to that amount of money to actually engage in Forex trading. Now, if Euro USD is trading at 1.1000 and you chose to use 1.10 leverage, then you have to put the 1/10 of the investment euro, that is 10,000 euro, as a margin, meaning 1,000 euro or 1,100 US dollar. Now, what is the advantage of Forex trading? Much higher return on capital. That is, if you are using one ratio 100 leverage, it means margin is euro 100 or US dollar 110. I hope you understand that. That's actually self-explanatory. That's very, very self-explanatory. Now, what is the disadvantage? A small price movement in the opposite direction can eliminate the whole amount you have committed. That is where leveraging comes. And you have to what? Minimize your loss. You need to be able to minimize. You need to be able to minimize your lot size properly. We're going to be talking more about that. Now, talking about one ratio, let's look at this other example. 1:500 leverage. It means margin is euro 20 or US dollar 22. Now, let's assume that euro USD goes up to 1:100. If you close a position, your profit is US dollar 100. That is 0.01 multiplied by $10,000. And that's giving you what? $100. Now, a small movement in your position can cause big movement in your profits or loss statement. Now, if euro or US dollar declines to 1.0978, your margin will be all used and you lose all the money you committed. This is very, very straightforward. Very, very, very straightforward. Very, very straightforward. Very, very straightforward. Now, this is the graphical example. This graphical example will give a better understanding of what I'm actually saying. This is margin trading. See your deposit. See how small your deposit is. With the help of leverage is the intermediary between your what? Your deposit and your purchasing power, your buying power. With the help of leverage, you can use your small deposit to place what? Bigger lot size. Bigger lot size. But the bigger the lot size, the more risk your account is exposed to. The more risk or danger your account is exposed to. Now, see the leverage. The leverage is the intermediary between your deposit and your what? Your buying power. See how small our deposit is, but with the help of leverage, you are able to purchase as much as this. We're able to purchase as much as this. Let me give you another example. Let's say you want to buy a phone. And initially, in real life, if you go with $100, you're able to get a phone. For example, that's not possible again. That's not possible again. Okay, let me use $1,000 for example. With $1,000, you can get it. Let's say with $1,000, you're supposed to get a phone. But with the help of leverage in Forex market, you can be able to purchase 1,000 phones with that $1,000. With that $1,000. That's just better explanation. That's much more better explanation. That's a better explanation. Now, let's go into the next topic, which is the trading side. Currency pair are traded in fixed contract size. Standard size is called a lot and is 100,000 units of the base currency. Now, this is where the help of leverage actually comes in. Now, one lot in US dollar. Let's say you open your trading platform and you just go to your lot size on your screen and you just put one lot size. Now, initially, if you have to use in real life, you have to use one lot size. It means you must have what? $100,000, 100,000 worth of dollars to be able to place that trade. Now, one lot in Euro USD, it means that what you must have at least 100,000 euro and one lot in GBP slash US dollar. If you are trading GBP against the US dollar, it means you must have what? 100,000 Great Britain pound. But with the help of what? Leverage, that is no longer what? Visible. Now, division of standard size, we have the mini lots, 1 over 10 of the lot size. That is $10,000 of this currency. Micro lots, 1 over 100 of the lot, and that's 1,000 of this currency. I don't want to stay too long on this. I will actually be explaining that better. Now, as you can see right here, with the help of leverage, see the benefits you have. This is the required margin, and see the amount of position size that we are able to do it. The place that we are able to place. Now, stick around. Part 2, we start from where? P and P value. What is pips and what is P value? Now, make sure you watch the part 2. Follow up to this extent. Make sure you watch the part 2, because with the part 2, you'll be able to understand a lot of terminology and how to, and the basis of Forex trading. Thank you for sticking around, and make sure you watch part 2. I'll actually be creating a playlist where I'll be combining the videos together for you to actually do what? Watch. Immediately watch this first one, go down under the YouTube channel, Non-Star FX. You'll see the second video. I can easily watch, and it's very, very what? Self-explanatory. Stick around. Make sure you subscribe, like, comment, and share. Thank you very much. In order to have more, in order for me to create more exciting and benefiting educational content like this. Thank you very much, guys.